In today's video, we'll help you understand why your universal life insurance policy is losing cash value or soon could be. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. One super common financial tool out there in the industry today is universal life insurance. And while there's many different types of universal life insurance policies out there, they ultimately all provide lots more flexibility than other policies and the potential for faster cash accumulation. So for a lot of folks, they're fairly attractive. Unfortunately, however, if they're not structured properly, nor if they're tended to over time, it can lead to a situation whereby the cash value accumulation stops and actually starts decreasing, even though the policyholder is continuously making their premium payments. Eventually, this will lead to policy lapse and policy expiration, which defeats the whole purpose of buying permanent life insurance, so that you'll have a permanent life insurance policy until the day you die. So in this video, we'll break down why this happens and what are some common situations that lead to this, and then ultimately what you can do about it. So let's jump in. As part of a good routine financial planning process, it's important to grab in-force ledgers for anyone that has permanent life insurance policies. And that's because assumptions change, insurance companies can make amendments to policies, and it's good to keep up on these because a lot of times nowadays, insurance policies are not set it and forget it. Specifically, when we do this with new clients, we'll call the insurance company and grab an in-force ledger, which is basically a projection year by year of what the insurance company assumes this policy will do over time. And it'll show projections of death benefit, cash value, and then expected premiums or contributions. A lot of times though, however, when doing this, we'll see that at age 80 for the client, roughly 70, 80, 90, somewhere in that ballpark, the cash value will actually reach zero and the policy is expected to lapse. And this is not under draconian worst case scenario assumptions. This is under reasonable assumptions. The policy is forecasted to lapse. For a refresher on how permanent life insurance policies are structured by way of things like death benefit, cash value, and then expected contributions, you can see my previous video, which I'll link above, that breaks down a little bit more detail. But for a super quick refresher, let's jump to the whiteboard. You have to account for three main variables: death benefit, premium, or your contribution level, and then cash value. Right? Generally, no matter what policy design, it's going to be structured similar to this. To keep it simple, let's say you have a death benefit of $1 million and it goes on forever, aka until the day you die. You have a premium, we'll keep it simple and say that's 10 grand and death benefit was $1 million. And the premium you're expected to also make contributions for forever. With a universal life insurance policy, however, one of the reasons why they're so attractive is that premium does not have to be maintained every single year. In some years you could fund it for a little bit and then you could stop. Other years you could fund it at a higher level and then stop, and maybe a lower level other times and then stop. Lots of flexibility. That's one of the reasons why universal life insurance is so popular. And the third component here is the cash value. Regardless of policy type, you'll see the cash value accumulate pretty similarly, which over time it goes up, right? And this break-even point to your total contributions into the plan, and when the cash value breaks even, it's probably going to be around year 16 or less, generally. Essentially, universal life insurance policies are very popular because of their increased flexibility and potential for cash value accumulation compared to other traditional types of permanent life insurance like whole life insurance, for example. It also was a helpful structure in bypassing a common objection people have to buying permanent life insurance. Doesn't it make more sense to just buy term insurance and invest the difference, aka invest whatever the permanent life insurance policy would have costed me for the same level of insurance? And universal life insurance can be analogized similarly, whereby you have term life insurance where the cost of that life insurance is assessed every single year as you get older, and then there's a side fund. And how the cash value grows is indicative in the policy name. So for example, universal life insurance or fixed universal life insurance, the credit into the policy is fixed. Now, it's not fixed forever. The insurance company can change that as interest rates change, and we'll talk about that later. And then with index universal life insurance, your policy's cash value accumulation is based on the performance of a particular index, plus some caveats, which we'll touch on later. And then variable universal life insurance, your cash value is invested literally into what are called sub-accounts, which are investment portfolios that you as the policyholder can dictate what those are, within a particular parameter. And then your cash value's performance is based on however those sub-accounts or however that investment portfolio performs. With universal life insurance, the cost of your life insurance goes up every year because you're getting older. So keeping it very simple, let's say you had $1 million of life insurance coverage. Every year as you get older, the cost for you to have $1 million of insurance is going up. And that's because the insurance company forecasts, under reasonable assumptions, that you're getting closer and closer to the day of dying, which is when they'll have to stroke a check for $1 million. Therefore, they're going to charge you a commensurate rate for that risk that they're taking on. And the cash value accumulating and then decumulating and eventually lapsing is not normally a problem if your contributions plus the cash value accumulation, whether it's fixed, index-based, or variable, as long as the cash value accumulation plus your contributions is enough to exceed the cost of insurance, then your policy is not in jeopardy. But when your contributions plus the cash value growth, however it grows, is not enough to afford the cost of insurance, that's when we run into problems. I call this situation policy auto-cannibalization, which is a pretty gross analogy, but it also refers to a pretty nasty situation, whereby the only way for the universal life insurance policy to sustain itself is to essentially eat itself by way of taking from your cash value to pay for the cost of insurance, because your contributions plus the growth were not enough. So essentially you can see how as the cost of insurance goes up more and more over time, and your cash value accumulation isn't enough at one point, it's definitely not going to be enough in the future. And so you see a precipitous drop in cash value accumulation, and eventually you see the policy end up at zero cash, which therefore is policy lapse. Now, this could also happen if, let's say, you took out a loan against your policy cash value through the insurance company, and your contributions weren't enough to afford the payment to, make yourself whole again. This could be the case whereby the cash value is being used to offset the payment you otherwise should be making to pay off your loan. This is not as common, but it could be a situation whereby you'd have policy auto-cannibalization. In this process, where the insurance company uses your cash value to make up for either lack of cash value growth or lack of contributions, this process happens automatically, and you may or may not get notified. For a quick, not so nasty visualization of auto-cannibalization, let's jump back to the whiteboard. You've got some level of premium, and let's just keep it simple and say you've been funding it the whole time. It actually might not even matter. So the reason that fundamentally you see your cash value go up, and then you see your cash value go down, and eventually reach policy lapse, and that's when you'd run out of death benefit, probably in your 70s or 80s. That's usually what I'm seeing in the projections. The reason this is happening is because your premium or your contributions, which is this, plus whatever your cash value is being credited is less than the cost of insurance. The cost of insurance, we'll draw another line here, the cost of insurance goes up every single year. And that's because every year you get closer to dying, the insurance company is going to charge you a commensurate premium for that. And that cost of insurance is assessed newly every single year. It's all within the policy, and sometimes illustrations will show the actual cost of insurance, but philosophically, that's what's happening here on the back end. Now, if your premium, which ideally would just stay the same the whole time, doesn't have to, but ideally it would, plus whatever your cash value is being credited, if that exceeds, right, the cost of insurance, then you're gold, and you're going to see a positive rate of return in your cash value every year over time. The problem is, right, when we use incorrect assumptions for what the cash value would grow by, yet the cost of insurance hasn't changed much, that's when you get that dislocation where the premium plus the cash value crediting, it does not exceed the cost of insurance. And you'll see that cash value either stagnate, right, or usually you'll just see it go back down. So you might be wondering, how in the heck did we end up in this situation in the first place? Well, a lot of it has to do with the insurance companies using unreasonable assumptions, and then the policyholders or the clients not taking the initiative to examine their policies over time. A very clear example as to understanding how this could happen was when universal life insurance policies were first invented in 1979. They were essentially sold as like the new hotness in the insurance space. Back in 1979, 1980, and 1981, the interest rate environment was at like 19%. So if I have a universal life insurance policy and I say, hey, for not a ton of risk, if you put money in here, your cash value will be credited at 19% every year until the day you die. That's a pretty awesome permanent life insurance policy to sign up for. And so people sold these in droves. A lot of people signed up. But now, as people are waking up, 40, 30, 20 years later, the policies are not performing as they were expected to. And essentially that means the policies are being severely underfunded for the previous assumptions that were being made because the cash value is not accumulating at 19%. For Gen Z and for a lot of millennials, you might not be aware, but back when interest rates were 19% back in the 1980s, essentially they were decreasing ever since until very recently in 2020, 2021. And so for the most part, every year one of these universal life insurance policies were sold back in the day, the assumptions were always too liberal because by definition, pretty much any year after the policy was sold, the assumptions weren't being met because interest rates were a lot lower. I'll link below to Fred, which is an online resource that tracks interest rates over time, and you can see this precipitous drop in interest rates over the past 30, 40 years. The other types of universal life insurance policies we discussed also suffered from poor assumptions. So for example, in like an indexed universal life insurance policy, which we'll get into the breakdown of how those work another time, but essentially your cash value performance is credited based on the performance of a particular index. You're not invested in that index, nor are you credited the actual performance of that index. Essentially, the insurance company uses that index as a proxy and says, okay, that index performed at X, therefore we will pay your policy X minus something. And that's because in indexed universal life insurance policies, or IULs, the insurance company places certain caps and floors, which means no matter what the index does, you'll never get better than this credited to your account. Also, no matter how poor the index performs, you'll never have less than this credited to your account. And usually that's zero. And so it's very easy for an insurance agent to market your policy can't lose money because the floor is zero. And that's not true because there's the cost of insurance. That gets taken out after your policy is credited the performance of the index. In addition, there's one more sneaky thing that happens on the back end, and that's a participation rate. Think of that as like a copay, whereby no matter what the index does, even if it does 1,000%, you only participate up to a particular percentage in that performance. And then the caps and floors are assessed. So essentially, if your policy participates in 80% of the performance, and then there's caps and floors, you can very quickly see how a new buyer of index universal life insurance would say, my policy is based on the S&P 500. S&P 500 does 8, 9, 10% a year. Therefore, that's what I'll expect in my cash value. And we could see how that's a very liberal assumption and most likely not going to meet your expectations. In addition, the insurance company has the ability to change the cap rate on your performance over time. So if you're not keeping up on these policies, you might wake up with a totally different policy 20 years after buying it. And another reason why you're seeing index universal life insurance sold a lot is because you don't need a securities license to sell an index universal life insurance policy. So if I'm an insurance company, I'm just cranking out insurance agents, throwing spaghetti against the wall and seeing who sticks around in the insurance space. It's a lot cheaper not to pay for all these people to go get securities licensed and take their 6, 63 or Series 7. It's way cheaper just to get them insurance licensed, which takes like a weekend, and then have them go out to market selling universal life insurance and index universal life insurance policies. And that segues to the third most common universal life insurance policy out there, variable universal life insurance. And this one's a little bit harder to mess up by way of assumptions, but it totally could happen too. So as mentioned before, your cash value performance is dictated based on what you as the policy owner decide you want to have that invested into, and those are called sub-accounts. Where this could go wrong, even though in my opinion it's less likely to, is if you have too liberal of assumptions on the portfolio you're using, or you start chasing returns in your sub-accounts and making trades over time. There might be a fee to do that, but nonetheless, we all know that day trading and crazy active management does not perform well over the long term. And so if a policy owner is making changes to their portfolio quite often, trying to chase, the newest rates of return out there, it's not unlikely that their policy would severely underperform what it otherwise would have done if they would have just left it in some type of like long-term target date stock market oriented portfolio. So those are some potential reasons why the infrastructure of these policies are susceptible to problems. In addition though, let's not forget user error. I'm not going to let policy owners off the hook. These universal life insurance policies are pitched as like flexible, great cash value accumulation potential, etc. And that is true. The problem is when a policy owner takes that a little bit too literal and maybe chooses to neglect this policy on purpose or by accident. So for example, that could look like, hey, I'm the policy owner, my insurance agent is telling me these policies are super flexible, I'm going to make a couple of contributions for a few years, oh, cash is tight, now I'm going to stop making payments for a little bit. And then that little bit turns into a decade. If the policy goes severely underfunded, yeah, you're going to see some auto-cannibalization over time, whereby your cash value will severely decrease and probably lapse on you. In addition, as mentioned before, let's say a policy owner takes out a loan, they're making some payments back to the policy, they're on track, everything's good, and then cash gets tight and they decide to cut back on making those payments and say, oh, I'll make up for it another time. And they don't. And then the policy goes down to zero. So regardless of whether it was a fundamental structure, improper assumptions, or policy owner neglect over time, we are seeing these policies start to auto-cannibalize, and that really hurts clients who are in their 60s and 70s now, who are seeing that their cash values are projected to go to zero within like the next decade. So let's talk about what courses of action you'd take if you are in this situation, or if you forecast being in that situation ahead of time. Well, the easiest solution is just to cancel the policy altogether. Take whatever cash value you have, minus any applicable surrender charges, and go home. You might pay a couple bucks in taxes on that cash value, but canceling it guarantees you won't have to afford the cost of insurance anymore because there is no insurance. But let's say you want to maintain the policy. There's a few options you have. Number one, the easiest way to do this is to drop the policy coverage. And this is through making a policy change. By definition, reducing the total amount of life insurance you have reduces the cost of insurance. So if by doing your math and forecasting, you see that the cost of insurance is too high relative to what you'd need to fund into the policy to bring it back to parity, plus the cash value accumulation, if that's too high, maintain your contribution in cash value accumulation, but just decrease the cost of insurance, aka decrease the death benefit. You'd probably want to work with your insurance agent or financial planner to find out the right amount of insurance to maintain so that the policy is projected to be solvent under reasonable assumptions, but that's totally an option. You can do a policy change. Another solution, if you wanted to keep the policy in force as it is today, is find out why the cash value is accumulating maybe too slowly. Perhaps if you're in a variable universal life insurance policy or an indexed universal life insurance policy, you need to change what the policy's crediting is based off of. For variable universal life insurance policies, that's super simple. You just grab a list of the fund options that you can invest your cash value into, and then pick one that has achieved a higher rate of return over time, and you reasonably forecast will achieve a high rate of return over time as well. And the last solution would be just to bite the bullet, find out from the insurance company what you need to contribute to the policy to sustain it from going to zero, and then make those additional contributions. This is normally the least attractive strategy because odds are, if you're running into this problem of auto-cannibalization in the policy, you're probably in your 60s or 70s, you've got your expenses laid out for retirement by way of portfolio withdrawals, Social Security, maybe some pension, and increasing contributions to an insurance plan probably won't be in your best interest. But it is nonetheless still an option. Okay, so as we wrap up, calls to action here. If you have a universal life insurance policy in some form or fashion, grab an in-force ledger from the insurance company using reasonable assumptions. Either task your financial planner to do this or on your own time, call the insurance company and dictate to them what assumptions you want to see run in the ledger. And then once you get the policy back, you'd look at the non-guaranteed cash values and see how that performs over time. You can outline it on Excel, or you can just look at the paper and go, okay, my cash value still seems to be accumulating well. Reasonable assumptions based on policy design would be, for example, like a universal life insurance policy, I'd recommend using about 4% crediting. For index universal life insurance policies, I'd recommend using somewhere in the ballpark of like 6 or 7% interest crediting. And then for variable universal life insurance policies, personally, I would use 8%, but then I'd also make sure whatever my sub-accounts were invested into probably will average about that, if not a little bit more. Once you grab an in-force ledger using those reasonable assumptions, if it looks like there's still no hope, then I'd action on one of the 4 aforementioned strategies. Number 1, cancel the policy altogether, take your ball and go home. Number 2, look at making a policy change by decreasing the death benefit to see if you can fund it at the same level and maintain, ultimately, still some solvency in the plan. Number 3, look at optimizing how the cash value is accumulating. Usually in a variable universal life insurance policy, that's going to look at maybe making some changes to the sub-accounts. And then number 4, just bite the bullet and make increased contributions to whatever level it needs to sustain the policy. I guess, of course, you could do a combination of all these, but to keep it simple, those are at least 4 options. If you have further questions, drop them in the comments below. Hope this was helpful. Have an awesome rest of your week, and we'll talk to you later. Bye.